when you think of a traditional factory, you usually picture like smokestacks or massive assembly lines,
Oh,
right?
yeah. Concrete floors, heavy steel presses.
Exactly. You can literally walk through the plant and see the capital investment right there in front of you. A dollar goes in, and you watch a tangible widget roll right off the conveyor belt.
It's highly visible. It's grounded in the physical world. You know exactly where the money went.
But if you look at a modern tech giant today, that
Hmm.
factory is completely invisible. I mean, it's just endless miles of server racks humming away in the dark.
Yeah, algorithms silently training on synthetic data.
Right. Code compiling with zero human intervention. You can't see the product, and you definitely can't hold it. And yet the capital required to build that invisible factory is just, it's eclipsing the cost of the biggest physical mega projects from the industrial age.
It really is. It's a completely different scale of investment.
So welcome to this Time and Market Deep Dive. Today's date is April 29, 2026. And our mission today is to unpack Microsoft's jaw-dropping Q1 earnings, or as they confusingly call it, their fiscal year 2026 Q3.
Right. Their fiscal calendar is always a little weird.
Always. Now, a quick reminder up front for you listening,
Yeah.
this deep dive is strictly for entertainment purposes. We're going to be talking about a lot of financial metrics, multiples, valuations, but you should always seek professional financial advice before making any actual investment decisions.
Exactly. We analyze the data, but we do not manage your portfolio.
Beautifully said. So getting into that data coming out of Redmond right now,
Yeah.
it is fundamentally rewriting how we understand corporate scale.
It really is. We are looking at a $3.19 trillion behemoth.
3 trillion.
Yeah, I mean, that market cap is roughly the size of the GDP of a major European nation. And somehow, and this is the wild part, they are putting up growth metrics you'd normally only expect from a scrappy, highly leveraged startup.
It makes no sense. So let's look at the actual numbers driving that scale.
Yeah.
The stock is hovering around $429.25 right now.
Right.
And this earnings report was just a massive top-line beat. They posted $82.89 billion in revenue for the quarter.
Which is an 18.3% increase year over year.
Just massive.
To put the sheer physics of that into perspective, 5 years ago, Microsoft was generating about $160 billion in an entire year.
Wow.
Now they are churning out more than half of that in a single 90-day window. Growing an $82 billion base by 18%, it defies the normal gravitational pull of legacy tech.
Because usually when a company gets this large,
Mm-hmm.
the law of large numbers kicks in and growth just flatlines.
Exactly. But they are completely bucking the trend.
They really are. And their GAAP earnings per share hit $4.27, beating Wall Street's consensus by like 5.5%.
Yeah.
But, and this is where I want to spend some time, when you look at the valuation multiples, you get this really fascinating divergence.
Oh, the PE ratios.
Yes. So they are trading at a trailing PE of 38.05, which is a steep, steep premium for any company, let alone one of this massive size. But then you look at the forward PE, and it drops down to 33.45.
And that compression is where the entire market narrative lives right now.
Walk us through that. Why does that drop matter?
Well, a multiple compressing from 38 into 33 indicates that Wall Street isn't just expecting, steady linear growth. They are actively pricing in a violent acceleration in future earnings.
Right. I always picture that kind of PE compression in a mega cap growth stock, like a coiled spring.
Oh, that's a great way to look at it.
Yeah, so investors are willing to pay this astronomical premium today. They're pushing down hard on that spring, right?
Yeah.
Because they are banking on the actual profits uncoiling and catching up incredibly fast over the next 12 months to justify that current entry price of $429.
That tension is exactly what you are buying at that price. You aren't paying for what Microsoft did last quarter. You are paying for the conviction that their operating leverage is about to kick into a totally different gear as these AI investments mature.
So we actually sat down and ran a full 10-year discounted cash flow analysis on Microsoft to see if the math actually backs up that conviction.
Right, the DCF model. Let's get into the weeds a bit.
Let's do it. So to figure out the intrinsic value, we used a base free cash flow of around $75 billion.
Which is fairly conservative given their recent operating cash flow, but a safe baseline.
Yeah, exactly. And we applied a growth expectation of 9% per year for the next 10 years.
9% is interesting. Some bulls might argue that's too low given the AI tailwinds, but for a $3 trillion company, maintaining 9% compounding growth for a decade is still a massive undertaking.
It is. So we run that 9% out for 10 years. And then for the terminal value calculation, basically what the company's worth forever after year 10, we used a 2.5% terminal growth rate.
Basically matching long-term GDP growth, standard practice.
Right. And to discount all that future cash back to today's dollars, we used a 10% discount rate.
Which is your required rate of return.
Exactly. So you plug all of that in, 75 billion base, 9% growth, 2.5% terminal, and a 10% discount rate. And the final calculated intrinsic value comes out to roughly $405 a share.
405, okay.
Yeah. So with the stock currently sitting around 429, it's trading at a slight premium to our base case intrinsic value.
Right, a premium of about 6% or so.
Which, honestly, for a company executing this well, isn't that crazy. And it perfectly aligns with current analyst sentiment. Wall Street has a very strong buy-to-hold consensus right now.
Yeah. The breakdown is pretty telling. You've got 11 buy or strong buy ratings, 10 holds, and literally 0 sell ratings.
Nobody wants to bet against them?
Nobody. And the mean target price from analysts is sitting way up at $496.79.
Almost $500.
Yeah. And what's wild to me is that the options markets are only pricing in a modest 4% post-earnings move. Nobody is panicking. Nobody is blindly euphoric. It's just this sustained, quiet confidence in the machine.
But that forces you to ask, like, where is that unshakable confidence actually coming from? Because when you have a $3 trillion company, you can't just rely on legacy software licenses to maintain a 38 PE multiple.
No, absolutely not. Windows and Office aren't enough anymore.
You need a structural tailwind that is practically immune to macroeconomic shocks.
Yeah.
And for Microsoft, that entire narrative rests squarely on one word: Azure.
The intelligent cloud segment.
Yes. If you dig into the cloud numbers, the standout metric is blindingly obvious. Azure grew by an astonishing 40%, or 39% if you adjust for constant currency.
Posting 40% growth on an infrastructure product that large is unprecedented. I mean, the enterprise migration to the cloud isn't a new story, obviously, but the velocity has completely shifted.
Oh, so?
We aren't just talking about companies lifting and shifting their old legacy databases to the cloud anymore. Every single organization on Earth that wants to deploy a proprietary AI model needs massive compute capacity.
And they can't build it themselves.
Exactly. So they are renting that compute directly from Microsoft.
So let's put that 40% growth in context against the other hyperscalers, because the competitive dynamics are really shifting. Amazon's AWS is sitting at 23.6% growth.
Right.
So Azure is severely outpacing the traditional market leader. Now, on the other hand, Google Cloud is posting hypergrowth at 63.4%.
But you have to remember, Google is starting from a much smaller base.
Right, and they are aggressively discounting just to win market share.
Yeah, Azure is eating into Amazon's lead at a phenomenal clip, and they are doing it without having to race to the bottom on pricing like Google.
The mechanics of how they are stealing that market share from AWS are really clever, actually.
It's all about distribution. AWS has always been the default infrastructure layer for the startup ecosystem, right? If you launched an app in 2015, you put it on AWS.
Sure.
But Microsoft is leveraging its existing massive enterprise footprint. If a global bank or, a massive logistics firm is already deeply entrenched in Windows, Office 365, Active Directory, GitHub creates a frictionless on-ramp to Azure.
So when that company decides it needs AI infrastructure,
Microsoft is already inside the building. The sales team already has the CIO on speed dial.
okay, so let's talk about that AI integration, because Microsoft loves to throw out these massive user metrics on their earnings call.
Oh, they do.
They reported that Copilot and their AI agents have surpassed 150 million monthly active users. And across their entire software ecosystem, they claim 900 million users are actively touching their AI features.
That's almost 1 billion people.
It is, but honestly, I hear 900 million users touching a feature, and my eyes kind of glaze over.
Because it sounds like pure marketing fluff.
Exactly. It sounds like fluff. I mean, everyone clicks the flashy new AI sparkle button on their Word document once just to see what it does.
Right. Write me a poem about my dog.
Right. But show me where this actually hits the income statement. Are we just riding a massive hype cycle here, or is this generating actual highly profitable cash flow? Is Microsoft making real money from AI?
The skepticism is absolutely warranted. We've seen enough tech hype cycles like the metaverse or Web3 that never actually translated into operating income.
Exactly my point.
But the numbers here tell a very different story. The broader Microsoft Cloud revenue hit $54.5 billion for the quarter alone.
Just for the quarter.
Yes. And the real proof is in the commercial bookings. We saw a previous quarter where bookings grew 112%. That wasn't driven by everyday consumers testing out Copilot to write a grocery list.
No, that's enterprise money.
Exactly. That was driven by Fortune 500 companies, and notably, OpenAI itself, signing multi-year, $100 million plus contracts for dedicated Azure capacity.
So they are locking in the absolute whales.
They are. When a global enterprise signs a 9-figure contract for AI compute, that revenue is recognized over several years. Microsoft isn't just generating one-off transactional revenue from curious consumers.
Right.
They are securing highly predictable long-term annuities from the biggest companies on the planet. The monetization is unequivocally real, and it's deeply embedded in locked enterprise budgets.
Okay, so the revenue is real. The demand is insatiable. But being the digital landlord for the AI boom isn't cheap. Building the invisible infrastructure to support a 112% spike in bookings requires an eye-watering amount of cash. You don't just find the capital for that in the corporate sofa cushions.
No, you don't. And this is where the earnings report moves from impressive to almost, well, structurally alarming.
Yeah.
The capital expenditures are historic.
Okay, let's look at the CapEx crunch. Microsoft spent $31.9 billion on CapEx this quarter. Let me just repeat that because it's hard to wrap your head around. $31.9 billion in 90 days.
It's staggering.
It is up 49% year over year. What physically requires that much cash?
Well, we have to understand the physical realities of AI. Roughly half of that $32 billion goes towards short-lived assets. We are talking about tens of thousands of highly advanced GPUs, custom silicon accelerators, and the highly specialized networking gear to link them all together.
Right, because training a frontier AI model isn't just running a program on a server.
No, it requires running entire clusters of these chips at absolute maximum capacity for months on end.
And the power density required for those clusters is insane. It's not just buying the chips, it's buying the liquid cooling systems. It's a heavily reinforced server racks because the equipment is literally heavier now.
Precisely. And that brings us to the other half of that CapEx, which is being poured into long-lived assets. Microsoft is signing 15-year data center leases. They are buying raw land. They are securing dedicated substations from power grids.
Oh, the power grid issue is fascinating.
Yeah. A traditional cloud data center might need 30 or 40 megawatts of power. An AI-first data center needs hundreds of megawatts. Microsoft is effectively becoming a heavy industrial infrastructure company disguised as a software vendor.
What's wild is that even with $32 billion out the door, it still isn't enough.
Not even close.
CFO Amy Hood was brutally honest on the earnings call. I have the quote here. She said, "We know we're behind. We do need to spend. They're trying to increase their AI capacity by 80% and nearly double their entire data center footprint over the next 2 years."
Which is a logistical nightmare.
Right. And even then, they are forecasting cloud supply constraints through at least June 2026. The demand is so ferocious, they literally cannot pour concrete and rack servers fast enough to capture it all.
Because the constraint isn't capital anymore. They have the money. The constraint is the global supply chain, power availability on regional grids, and, honestly, the literal limits of physics in moving heat away from silicon.
And they're doing all of this not just for their own enterprise clients, but fundamentally to power their relationship with OpenAI.
Yes, which is a huge piece of this puzzle.
Which brings us to the most complex and maybe the most uncomfortable line item in this entire report. If you hold MSFT in your portfolio, seeing a massive hole burned in your quarterly statement by a partner company probably makes your stomach drop.
Oh, absolutely.
Microsoft took a $3.1 billion hit to their net income this quarter, caused directly by their investment in OpenAI. And some back-of-the-napkin math suggests OpenAI itself might have lost around $11.5 billion total for the quarter.
It's burning cash at an unprecedented rate.
At what point does bleeding $3 billion every 3 months for a partner become a toxic investment? I mean, that's a liability, right?
It looks catastrophic on the income statement, I'll give you that. But strategically, you have to view that $3.1 billion not as a loss, but as an insurance premium.
An insurance premium for what?
for dominance. Microsoft engineered an absolute masterstroke with the recently restructured OpenAI partnership. They didn't just hand Sam Altman a blank check to burn on compute.
Right.
They secured a 27% equity stake in OpenAI's new for-profit entity, and they locked down intellectual property rights to OpenAI's models all the way through 2032.
Okay, but the IP rights are only good if OpenAI actually stays exclusive to Azure, which brings up the AGI clause, right?
Yes. This is the critical piece that changed in the restructure.
Mm.
So AGI, or artificial general intelligence, is essentially the threshold where an AI system outperforms humans across most economically valuable tasks.
The holy grail of AI.
Right. Now you have to remember, OpenAI started as a nonprofit research lab afraid of AI destroying humanity. Under their original agreement, if OpenAI unilaterally declared they had reached AGI, they were allowed to sever their exclusivity contract with Microsoft.
Wow.
It was their ethical ripcord.
It was essentially a massive legal loophole. They could wake up on a Tuesday, unilaterally declare, hey, we built AGI, and instantly strand Microsoft after Microsoft funded all the research.
Yep.
They could theoretically shop their models to AWS or Google Cloud the very next day.
It was an existential risk to Azure's entire AI narrative. But under the new terms, OpenAI can no longer just declare AGI on their own. It now requires verification from an independent expert panel.
Microsoft's lawyers essentially disabled the ripcord.
Exactly.
It's like a prenup where the only way your spouse gets the house in the divorce is if a panel of Supreme Court judges agrees that you went completely insane.
That is a brilliant way to look at it.
It just takes the power to break the contract completely out of the partner's hands.
It punts the threat of Microsoft losing its exclusive API rights far into the unknown future. It protects Microsoft's ultimate cash cow, which is Azure's lock-in. So going back to your question, that $3.1 billion loss isn't a failure. It is the calculated cost of cementing a monopoly on the infrastructure of the AI revolution.
So they are bleeding cash to build this bulletproof, future-proof AI moat. But like we said earlier, you don't find $31 billion in the sofa cushions. You have to ruthlessly prioritize your capital.
Which brings up a really uncomfortable reality for anyone who grew up playing Halo.
Yeah, we need to talk about the physical hardware business. Because while they bet billions on the invisible infrastructure of the future, one of their most famous physical products is showing serious signs of fatigue. This is the glaring negative in the report.
The more personal computing division is facing a severe reality check right now.
Xbox hardware revenue plummeted by roughly 30% overall, and specifically dropped 33% in this Q3 timeframe compared to the prior year.
That's a steep drop.
People are simply not buying physical Xbox consoles anymore.
The natural hardware life cycle is definitely a part of it. I mean, we are late in the current console generation, but the structural decline is undeniable.
Right.
What's telling is when you contrast that collapsing hardware revenue with the content and services side of gaming. Content and services revenue was relatively stagnant, fluctuating between, down 5%, up 1%, depending on the specific quarter's comparables.
But wait. They enacted price hikes for Game Pass, and they fully absorbed the massive revenue stream from the $69 billion Activision Blizzard acquisition.
Exactly.
Even with Call of Duty under their umbrella and charging gamers more monthly, the software side is barely treading water, while the hardware side is just falling off a cliff.
It's a tough look.
It makes me think of the loss leader hot dog at a warehouse club, right? Like Costco sells a hot dog for $1.50 just to get you in the door to buy a $1,000 TV. Are they just keeping the physical Xbox console alive on life support strictly to sell Game Pass subscriptions? Or are they preparing to abandon the box entirely?
The data points to a very deliberate shift in corporate strategy. You see, a 33% drop in hardware revenue sounds disastrous on the surface. But if you look at the broader division, the overall gross margin percentage for more personal computing actually increased.
Wait, how do you increase margins when your flagship hardware is tanking?
Because the sales mix shifted specifically away from that low-margin hardware. Video game consoles are historically sold at a loss, or at best, razor-thin margins. You spend hundreds of dollars to build the box and make it back slowly on game sales.
Okay, I see where you're going.
By selling fewer physical consoles, but maintaining or slightly growing the revenue from higher-margin software, Game Pass subscriptions, and search advertising, the division intrinsically becomes more profitable.
So the 33% drop isn't necessarily a failure, it's trimming the fat. They are intentionally letting the hardware wither because the physical margins are just terrible compared to software.
Microsoft is ruthlessly prioritizing profit margins over legacy brand nostalgia.
And this matters to your portfolio because it shows management discipline.
Exactly. They recognize that the era of winning the physical console war against Sony or Nintendo is over. They don't care about moving plastic boxes. They want to win the software and subscription ecosystem across every screen, whether that screen is a PC, an iPhone, or even a competitor's console.
That perfectly synthesizes the overarching narrative of this entire $82 billion quarter. If you're looking at Microsoft right now, you are really looking at two fundamentally different companies existing under one ticker symbol.
It really is a tale of two companies.
On one side, you have this unstoppable high-margin cloud and AI juggernaut. It's growing Azure at 40%, it is generating tens of billions in cash, and it completely justifies that compressed forward PE of 33, which leads to our DCF value around $405 and that widespread analyst target pushing 500.
Right, the AI growth engine is very real, and the valuation while premium makes sense if you believe in the long-term cash flows.
So given our DCF analysis and the current price of $429, what's your final verdict?
Because it's trading at a slight premium to our base intrinsic value, but has massive proven tailwinds, I'd say it's a solid hold if you already own it, and a long-term buy on any market dips. You are paying up for quality.
I completely agree. But then on the other side of that coin, you have a legacy physical hardware business that is quietly, methodically shrinking into the background. It's being fully sacrificed at the altar of software margins.
Yep. Xbox, Surface, all of it is taking a backseat to the cloud.
Which leaves us with a really fascinating, lingering thought to mull over. We started today by talking about the shift from physical factories to invisible infrastructure.
We did.
As Microsoft signs these massive 15-year data center leases, buys up capacity on nuclear power grids to run AI clusters, and simultaneously watches its physical Xbox and PC hardware sales dwindle year after year.
Yeah.
Are we rapidly approaching a future where the original personal computer company produces almost no physical products at all? Will Microsoft eventually exist entirely as an invisible AI cloud that silently runs the world?
The blueprints for that invisible factory are already drawn, and as this quarter shows, they are already pouring the concrete.
A completely invisible empire. Thank you so much for joining us on this Time and Market Deep Dive.
Yeah.
Keep asking questions, keep looking past the headlines, and we will catch you on the next one.